Hi, and welcome to the Stockscores Market Minutes for December 5th, 2011. This week, the title of the presentation is Planning the Trade. I'm going to go through a couple of examples right off the top here of what I mean when I say planning the trade. Now, this is a top performer in a tough market. This is the weekly chart of TELUS going back 5 years. And you can see that over the past 2 years, while the overall market has been pretty tough, TELUS has actually done very well. Now, the reason I point this out is because the pattern that brought out that longer-term upward trend was a fairly predictable one. You can see that we had what we call an ascending triangle pattern that built about 2 years ago, and we ultimately had a break from that ascending triangle pattern, and that's a very typical reversal pattern. Step 1, break of the downward trend. Step 2, the formation of a rising bottom consolidation. And then step 3, which was right here, the break out of that rising bottom consolidation leading into an upward trend. Now, when I talk about planning the trade, what I really mean is looking at stocks and asking yourself, what do I need in this stock's chart for it to be something that I want to buy? If you were back in this time zone right over here, what you would need at that point was a break through $36 a share. And when that came, because everything else was in line for that classic reversal pattern, which I call a bottom fishing pattern, when you got that break through 36 up into that $38 range, well, now you've got the reason to take the trade. But the plan was to wait for that to happen. Now let's take a look at the chart of Research in Motion, which has certainly been, one of the disaster stories in this market. Has been beat up far more than the overall market. Well, right now it remains in a downward trend, but what is, I think, kind of important to notice is that this pattern that's building right now is something called a falling wedge. What that means is that the bottoms are not falling as quickly as the tops are falling, and that is a pattern that tends to come before a reversal. Now, what we need for this pattern to be something worth buying is a break through this red downward trend line. And right now I would call that a break through $20 a share. Now again, we're looking at the weekly chart here, but you could apply this same pattern to the daily chart. It just looks like it's been building over a little longer time. So what's important with a falling wedge is a break of that downward trend line. However, it's also very important to wait for the break of the downward trend line. Trying to anticipate it because we're in a falling wedge is not a good idea. Now, if the market can break through, as it is now, the $20 price mark, although we could see this falling wedge last for a few months, in which case it could be a breakthrough $15 a share. We don't know yet. But once we get a break out of that wedge, well, we then expect the market can rally up to that long-term downward trend line, which is the red line that I've drawn here. So suppose we get a break next week through 20, we close the week at 22. Our expectation is that the market could rally up into that $40 range perhaps. That's a trade worth taking because the upside potential justifies the risk of the trade. So that's what I mean when I talk about planning a trade. Now, I've done it here on a very long-term sense, but you can do that when you're day trading as well. Look at charts, decide what you need to have happen for you to be willing to take the trade. All right, let's get into the analysis. We're going to start off with a euro, and this week I'm looking at weekly charts for everything. I want to try to cast some light on the long-term view for these different instruments that we look at every week. Well, right now the euro is in a pennant pattern building process with a lot of volatility still. That means that there remains a tremendous amount of uncertainty about where the market is going. We've certainly felt that in trading. We're at the bottom end of the range, and so my expectation is that we're more likely to move up in the weeks ahead in the euro, which should mean move lower in the dollar, which should mean higher in stocks and commodities. However, we still haven't broken off of that bottom part of the pennant, which is where we're at right now, and until I see a little bit more confidence in the chart, I'm going to remain relatively pessimistic about the euro. Now remember, this is a weekly chart. This means that we could go up for a week or two, but it may take months before we actually start that rally in the euro up toward the top part of the pennant. All right, next chart, US dollar. US dollar broke its downward trend line a few months ago. It has been bouncing around with a lot of volatility since then. we're near the upper end of the range, and so the inclination that I have is that US dollar goes lower. But you know what? For 2 or 3 weeks, we could go up higher, test resistance before going lower. And so if you are a trader, I wouldn't worry too much about what the daily chart is saying, or pardon me, what the weekly chart is saying. If you're a shorter term trader, you want to look at a different time frame than we're looking at here. However, if you're a more passive trader, longer term view, you look to hold stocks for months or even years, what we're seeing here in the US dollar is the likelihood that the US dollar goes lower, which should be supportive for stocks longer term into 2012. The gold chart remains in that long-term upward trend, but we're also still quite a distance above this upward trend line, and we've got that falling top building. And so in the very long-term sense, we've got a great upward trend, great momentum, but I kind of think we could see this pullback down to that upward trend line. And so no reason to sell gold here, but I would be a little bit cautious because of that falling top and because we are quite far above the upward trend line. Here's the chart for oil. Oil's had a great move the last few months, but in the context of where it's been over the last few years, we really remain stuck in that sideways range. It's been a stable range, when you consider what stocks have been doing, what a lot of commodities have been doing. Oil's done pretty well. It's held its own, and so I think it's a safe place to be. But, the upside $25 to $30, downside $25 to $20, I'm not really crazy about the reward for risk relationship in oil right now. Chart of the S&P 500 is building a pennant pattern. It is a somewhat, I would say, bearish pennant pattern simply because we also broke that long-term upward trend line earlier this year when we made that breakdown there. Lots of volatility, lots of uncertainty, but in the context of what we talked about with the US dollar and the euro, maybe we could get a breakout out of this little pennant pattern in 2012. Near term, I think this market goes sideways for the next little while. The TSX 60 index, T.XIU is the ETF that I'm showing here, is in a bearish trend. It does have some pretty good support at the green line that I've drawn. We've bounced off of it once, we've bounced off of it again, but we remain in a pessimistic mood here because we have not yet broken that downward trend line. Now, when we think about planning the trade, for me to become bullish or at least a little bit optimistic on Canadian stocks, I want to see a break of that downward trend line. And if you are a longer term trader, more of an investor, that's what you want to watch for in order for you to move out of cash. So my ratings then, neutral on US stocks. I'm probably on the pessimistic side of neutral there. Canadian stocks, I remain pessimistic. Good support. We could see a break of that downward trend line. When that happens, we'll change our view. Gold, neutral. Great long-term trend. I just think that the risks are for a pullback to that upward trend line. And oil, I've got rated as neutral. Short-term, it's been solid, but in that big picture view, oil remains in a sideways trading range. I think fear is less of a factor in the market, but there still remains considerable uncertainty. That means you got to dance pretty close to the exit door on any trades you make, and this remains a trader's environment. Well, that has been the Stockscores Market Minutes for December 4th, 2011. A reminder, if you are not already a subscriber to the free weekly newsletter from Stockscores, go to the address that you see on screen to sign up for that, and we'll send that to you each weekend completely for free. Have a great week in the market and trade well.